As much as I'd love to tell you that I keep every rental I buy, the fact of the matter is that sometimes forces out of my control can require that you exit an investment before your initial plan. But whether it's new legislation or a declining neighborhood or even a strategic move up to a better investment, determining how to exit that investment is something you should put some thought into. Here are a few options for you to consider and possibly some scenarios where they can be the most beneficial. Hello friends, and welcome back to the channel. My name is Sylvia Christensen. I am the associate broker at Wealth Builders Realty in Nampa, Idaho. If you've been wondering where Nampa, Idaho is, wonder no more. Check out this video on why you should know about Nampa if you are an aspiring real estate investor. If you would like to know more about investing in the Boise metro area of Idaho, please contact us and any of the methods listed in the description. We would love to have a conversation with you on how to get you started in your journey to financial independence through real estate investing. So here on the channel, we focus quite a bit on how to get into the real estate investing game. We do our best to teach you how to get yourself ready to invest by credit preparation, financing options, and legislation to pay attention to before you buy. We also teach you how to look for that property that best fits your goals and lifestyle. We all have different cash reserves and time constraints that will make our investment choices different. And of course, once you buy that great asset, we cover how to manage it so that it continues to produce the highest return for you in that investment. All that being said, today we are looking at a very important aspect of keeping your investment portfolio on track to your financial goals. And that means going over the many exit strategies. What happens when you make the decision to get rid of one of your properties? As with anything real estate related, there are numerous financial implications that have potential to make you money or cost you money. I hope that by the end of this video, you will have a better understanding of each of these strategies and will be better equipped to choose one in the future as you consider the necessary changes to your investment portfolio. So let's get to it. Straight out listing the property is the most straightforward option. You hire an agent, you get a market analysis of the price, and you get her sold. Unfortunately, this will also be your most expensive option. As with any sale, you are looking at commissions, title fees, possible repair costs. You might also have to chip in some closing costs to help the right buyer close the deal. Then there are the tax implications. It is no secret that Uncle Sam likes to take his cut on any gains you've made while you've owned the property. The amount you will pay depends on how long you have had the property. If you owned it for 1 year or less, let's say it was a fix and flip, you are subject to short-term capital gains taxes, arguably the highest tax out there. In essence, you are getting taxed at ordinary income tax rates. These are the federal rates for 2024. Keep in mind that you are subject to state taxes as well. If you're making $45,000 a year and make another $30,000 in capital gains, just about all of that $30,000 will be taxed at 22%. Yikes. You're paying more on capital gains than on your income. Now, there is some relief in sight if you hold the property for longer than the 1 year. At that point, selling it would subject you to these more favorable tax rates. At most, you stand to pay a flat 20% if you're in the highest earning bracket. As a side note, President Biden has a new budget proposal for 2025 that will impact the way capital gains are taxed. Check out a future video where I cover how these proposed changes might impact you should they go into effect. Despite the higher cost, selling a property outright might be what needs to be done if you absolutely need the full equity from that property. Now, if you have more time to plan this exit, you might be a good candidate for this next option. You move into the property for 2 years, then sell. If you have time to move into your rental for at least 2 years, which by the way, do not have to be consecutive, you might be able to take advantage of the home sales tax exclusion offered by the IRS. In layman's terms, every homeowner has the ability to claim up to $250,000 in capital gains per single filers and up to $500,000 for married couples from the profit of their personal residence. If you and your spouse bought a home for $100,000 and sold it for $500,000, so long as you lived in it for at least 2 years, you would pay zero on the $400,000 profit you made. Nice deal, right? Of course, there are a few details to keep in mind. First, this only applies to your home, which begs the question, do you have 2 years to spend living in this house? 2, do you even want to live in that house? I do my best to keep this at the forefront when I consider properties that I buy. And third, You can't take the exemption if you bought this rental as part of a 1031 exchange, since capital gains have already been deferred. Uncle Sam says it's time to pay the piper. This fourth one is a little tricky. If you took an exemption on another home within the last 2 years, you would not qualify again on this property if you lived in it for 2 years with the time in between, so not consecutively. Here's how that might happen. You live in your home in California for 2 years. Then you move into your rental in Idaho for 1 year. You move back to California because you can't cut the winter here, and you live there for another year. You then realize that California laws and politics have gotten increasingly worse since you've been gone, and decide to cut ties and come back to Idaho to brave the minor snow. You sell that home in California and claim the home sales tax exclusion on that profit, paying 0 capital gains tax. You move back into your rental and you live there for a year before you realize that it's got the makings of a rental and not your home. So you decide to buy another home and put this rental up for sale, thinking you can take another capital tax exemption because you did live in that rental for at least 2 years. IRS says no go. You can only take 1 exemption per 2 years. So after your visit to the tax advisor, you call the realtor to take it off the market and you move into it while you build a new home that you move into after living in this rental for another year. Then you sell that rental and now you can take that exemption. Ta-da! Yes, quite a bit of work, but with the sort of appreciation numbers that we have seen in the last 10 years, it might be worth it if you want to save yourself some serious money as you exit a property or even a real estate investment portfolio. On to the next one. 1030 exchange for another like-kind property. Perhaps your reason for exiting from a specific property has nothing to do with your need for immediate money or even getting out of the real estate game. Maybe the exit for a specific property is merely the cost you pay to enter into a much more profitable venture. If you are in growth mode and are looking to increase your cash flow or your net worth, you might be thinking about exchanging that single family rental for a fourplex. Selling that $300,000 home and buying a $700,000 fourplex would certainly have the potential for increasing your net worth faster than a single family home. So as mentioned previously, selling any property will carry quite a bit of costs with fees and taxes. Doing a 1031 exchange can help mitigate the tax portion, which might be the bigger expense. Currently, the IRS allows you to defer any taxes owed on the sale of a property if you use the proceeds to buy another one. As with anything the government allows, there are important rules to adhere to when you decide a 1031 exchange would be a good option for you. First and foremost, your new property needs to be of equal or greater value than the property you're selling. Failing to meet these amounts can result in taxes owed despite the 1031. Second, timelines matter. You have 45 days to identify a new property and 180 days to close on said property. Not doing either of these in the strict timelines allowed will make some deferred taxes impossible. Third, you cannot touch any of the money. Normally in 1031 exchanges, you have a third-party mediator called a qualified intermediary. This intermediary is in charge of handling all the money. They ensure that the timelines are met and that any money not invested into the new property is reported properly for capital gains taxation. There are other nuances that go along with a successful 1031 exchange. Be sure to check out this video where I cover the ins and outs of 1031 exchanges. Now, what if you want to have your cake and eat it too? Well, maybe this next option might work for you. Refinancing for an infinite return. As you have probably heard me say on this channel, real estate has appreciated quite a bit recently. If you were lucky enough to have purchased real estate in the Boise metro area even in the last 5 years, you would see that your investment has accumulated significant amount of appreciation. If you know how appreciation, debt reduction, and equity all play together, you know that the more your property appreciates, the more equity you have. And equity, my friends, translates to money into your pocket when you sell or refinance a property. So if you wanted to buy another property in the effort to grow your real estate portfolio using the equity you had accumulated in your current rental, a sale of that property might not be necessary if you could do a cash out refinance to pull your invested capital and then utilize that money as a down payment on your next purchase. Let's look at some numbers as an example. Say you bought a property here at the end of 2016. Just in time for Snowmageddon. Lucky you. Let's stick with averages for easy comparisons. If you bought the average priced home, it was right around $255,000. It would have appreciated about 9% just in that first year, then another 16.9 in 2018, and more each year until today. Even with taking that slight 3.1% dip in 2023, you would be looking at a property now worth about $604,000. Clearly, any money you invested in the property could easily be recouped through a sale or refinance. In this case, refinancing that property to take out at least your initial investment would allow you to have what we call an infinite return on that investment. You earn an infinite return on anything where you continue to make money through cash flow or appreciation, despite not having any more money invested in that property. Although you are not technically exiting from this property, your risk of losing money on that property has been eliminated. Sometimes you are just tired of managing a property and want to sell, but don't want to pay the capital tax gain, nor have the desire to move into the rental for 2 years to avoid said taxes. So what do? You might consider becoming the bank and carrying the note for your buyer. Offering seller financing on a property you own free and clear can minimize the taxes you have due at one time while also removing your responsibilities to maintain that property. There are many ways to structure the contracts in these sales, but the most common I have seen is where the seller can do a straightforward carryback note. The seller collects a down payment and the balance is paid back within a certain term at a specific interest rate with a balloon payment normally due at some point, let's say 5 or maybe 10 years. Remember, when you sell, your capital gains rate is dependent on your income as well. A big chunk of money realized by a straightforward sale can throw you into the higher tax bracket pretty quickly. Conversely, if you only claimed a portion, say the down payment on a seller carryback transaction in that first year, and whatever is paid off yearly on the other years, you can spread that tax expense over the years that you finance that property. Meanwhile, since you transfer that ownership, you are no longer on the hook for maintenance, taxes, insurance, and any other costs associated with you owning that property. Of course, as with any loan, there are risks. Banks take a risk on you when they lend you money, and you are taking a risk on the buyer when you lend them money to buy your house. Just like the banks put up the home as collateral, you would do the same in your transaction. If your buyer defaults, you will have the expense of evicting them and foreclosing. But at the end of the day, you will get your property back and sell it to the next buyer. Depending on your situation, who knows? You might be in a position to change your sales approach. Maybe you do a straightforward sale and just take the tax hit at that point. Or maybe you hire a property manager and rent it out again. All right, friends, I hope you have a few more options now in your tool belt. Here is a recap of things to consider before choosing any of these. Existing market conditions. Current real estate market conditions can significantly affect your selling price and the time it takes to sell. Then there's tax implications. Capital gains tax, depreciation, recapture, and other tax considerations should be evaluated with a tax professional. Then you have costs involved. Consider costs such as agent commissions, closing costs, and potential prepayment penalties on loans. Then there's legal implications. Ensure compliance with all legal and contractual obligations related to the property and the sale process. Consulting with real estate professionals, financial advisors, and tax advisors can provide you with a more personalized plan for your specific situation and for your investment goals. I would love to offer my assistance. Please comment below or reach out to us directly. Thanks for watching.